Why traders succumb to the dark side. Hi, it's Charlie giving you Saturday's video. I hope you're very well. So what we're going to do is we're going to talk about succumbing to the dark side, but I'll also include a little bit of market commentary this weekend as well. So the problem that we have with trading is that the markets are constantly challenging you. It's like the market is the devil. It's the dark side. It's the dark side of the force luring you in. Come on over to the dark side. What I mean by that is the market wants you. It wants you to do the wrong things. It's urging you on to do the wrong things. Let me give you an example. So you imagine, if I take this back here for a minute, you imagine you get into a nice long position. You've got a stop loss here, for example. So here's your stop loss, and the market's starting to run for you in a nice bit of open profit. And then the market rolls all the way over, nicks you out, only to then maybe come back up again. Now, a classic reaction from a trader, there's two reactions that you have here. One is the feeling of remorse that you saw open profits come all the way back into a loss, and the other one is the reaction that you must do something, you must make a change so this doesn't happen to you again. So whereas, well, I'll tell you about what you can do instead, but so what happens is that a trader will say, well, obviously my stop must have been wrong. Now that it could be that the stop was wrong, but it might not be. You might just have to accept that it's just one of those things in trading, because we have to put stop losses in somewhere. But the problem is that a trader in the future might actually move their stop further and further away, or not put a stop in at all. So that's, again, part number one, where you succumb to the dark side, because then you start thinking, well, I'm not going to put this stop in. Look, I was right all along, so therefore next trade I won't use stops, because the market's out to get you if you use stops. And you hear this sort of language, and people will use that sort of language. Or people will then say, right, okay, well, I'm not going to allow this to happen to me again, so what I'm actually going to do is I'm going to aggressively move my stops up. And so therefore, if this happens again, I can't possibly lose, so to speak. So it all comes back down to a trader's desire not to lose. And the problem with aggressively moving the stops up, which is fine, again, if the approach dictates that you do that, but if you do it on every trade, you're never going to get to those winners that end up coming right up to here, for example, because if you trail your stops aggressively, the market will do retracements, and so you will always get trailing stopped out. Now, again, it's not necessarily a bad thing if that sits well with your approach, but you can't expect to ever get to these higher returns or higher targets if you trail your stops. So what's essentially happening is that the market has won. The market has ensured that you've moved over to the dark side, and the dark side is reacting. It's reacting, thinking, I've got to do something to make changes because this has happened. And it's not necessarily the case. Now, of course, it could be the initial stop was too tired anyway, or whatever. But the reason I'm talking about this is because this very thing happened to me in the past week, where exactly this happened. In a nice open profit, market rolled over, ended up getting stopped out by 10 pips, only for the market to then, the market I was trading to then come back up. So, but I won't look at it and say, oh, it's the market out to get me, it's a conspiracy, it's market makers, because it's not. The market, my stop was in a good level, and the market just came down, and just so happened that it came down. The market isn't looking at me by myself here and thinking, right, let's get Charlie Burton. It's just the level, and it was a good level. It wasn't an obvious stop loss or anything like that. It's just one of those things. So there's nothing you can do about it other than to sit back and say, well, at least my analysis was correct. It's one of the best things you can do, because then if you have that kind of approach and say, well, there's nothing I've done wrong, it's just on this occasion this has happened. Now, if I take the next 100 trades, and out of the next 100 trades, this will happen again. I can guarantee this will happen again. But over those 100 trades, there will be plenty where this doesn't happen. And I do get to my overall targets. If I start making too many changes and adapting, thinking I've got to adjust to what's going on, I can't have this happen again, then what's going to happen is over those 100 trades, my overall profitability will be lower, because I'm tweaking and effectively it's like curve fitting. I'm constantly curve fitting my approach almost on a trade by trade basis, because I'm more concerned about wins and losses, and that's the problem. Again, succumbing to the dark side, you get too wrapped up in having a winning trade or a losing, or especially a losing trade, and having to fix the problem. And it might just be that there isn't a problem there. So that's really the answer, is there isn't necessarily always an issue that we have to fix. We feel it as human beings that, oh, there must have been something wrong. What can I do better next time? And we have that type of mentality. The problem with that is, like I've just said, you end up curve fitting your own approach, and your strategy might be nothing wrong with it. You just need to go through what I often call acceptance. Accept that over 100 trades, there are going to be trades which are going to be frustrating, but that's just part and parcel of the process of trading. So there you go, a little bit on succumbing to the dark side. Don't allow yourself to succumb and then start becoming an overfitter and curve fitting your, what could be a perfectly fine approach to the market. All you end up doing is messing yourself around. The market's then got you, and you just become one of the emperor's apprentices. Right, let's move over to the markets themselves. Now, I'm going to start here with the dollar index itself, because what was fascinating today, the dollar was much more interesting than the stock markets, actually. We had non-farm payrolls. Now, non-farm payrolls over the past year have, the last couple of years, a lot of the time, you get some intraday volatility, but you look at the end result, and the last non-farm payrolls, I think, was on this date here, and it was just a meaningless candle range on that particular day. And that's what we see, a little bit of intraday volatility, but not any huge ranges. Now, what happened yesterday was the irony of ironies was that actually the headline figures for those non-farm payrolls should have been dollar supportive, dollar positive, and yet the dollar had one of its largest down days, as you can see, or of any kind of day. That I'm just scrolling back here. I don't know what maybe this back here in 2021 was some big moves there, but one of the largest days that we've seen in the dollar index there for quite some time. Whether it amounts to anything, we'll have to see, because we've got inflation, the big CPI inflation figures coming out next week, and who knows, this could all get turned back around again if we get a hot print. Now, we did have a hot print in October, and yet the dollar sold off on that, so that was a bit irony as well. But nevertheless, we have got some big news coming out later next week, which should massively affect the dollar again. So yeah, the funny thing was that we had fundamental news coming out which should be supportive of the dollar, but the dollar sold off. So I think this is the one thing, it's trying to, when you're looking at the macro and the fundamentals, is striking a balance between what the fundamentals are and also what price action is telling you and what price is doing. So for whatever reason, and there's all sorts of other reasons, there is some layers within that report. The household survey was negative, unemployment rate actually ticked up. So, but wage inflation was still strong, and the headline jobs growth was still strong. But then there were other things going on in the economy on a macro basis yet there yesterday as well. We had Fed speakers. So anyway, there were other and one or two of those Fed speakers did hint again at a slight that maybe the, the the size of future rate hikes could be lower. And so, again, the market had already moved long before Collins was speaking there. So anyway, that's what it was. That was the reaction there. So much bigger reaction than we've seen to a non-farm payrolls in a very, very long time. So what does it mean? Well, firstly, if we crunch this up a little bit here, we can see that the dollar index really since June, the lows around June of last year, 2021, has been in a rip-roaring trend. And it still is in a rip-roaring trend. So do bear that in mind. The dollar is in a very strong trend. As we can also see, if I zoom in, the dollar has been tracking, or the 50-day moving average, which is my black moving average line here, has been tracking the dollar since that time, since the dollar broke up. It's had slight overshoots along the way, which is natural. But here we are again on this 50-day moving average. So what I would suggest is that the market keeps coming back down to it, and it's like skimming a pebble across a pond. And the pebble, as it bounces, 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 at some point it's going to lose that inertia and fall through the surface of the pond. So if after next week's inflation report, next Thursday, if the dollar does get materially below this 50-day moving average, then there is scope for more material downside retracement. However, the 50-day has been very supportive, and if this turns back around again, then a natural level would be, yesterday's highs would be a natural level from which, okay, the dollar's turned back around and now heading back north again. So quite simple there for the dollar. Now, the stock market indices weren't quite... intraday, they were moving around quite a lot, but as far as the end of day sort of range is concerned, this is the S&P here, it wasn't a huge day like we saw in FX land, and so not as much to say there other than the fact that if we go down to an hourly chart, you'll see that this was really quite a volatile day because it was up and down a lot. So again, with the S&P at the moment, it came up to a natural resistance, which is along here, and it's reacted to that. So we have reacted to the downside. Again, time will tell if this is going to fall over some more yet. Yes, Friday's had an update, but in the grand scheme of things, it doesn't necessarily mean anything just yet. I think that there's probably what I call more work to be done if the S&P is going to push higher. The first thing would be to get above that daily 50, my black moving average there as well, for the S&P. So there is some work to be done. There are some divergences on the S&P which could see the S&P go higher, but in the short term here, it's reacted to that prior resistance zone, so it needs to get back up there. And if it gets back up to there, then the potential for more upside is certainly on the cards. However, we are from a fundamental backdrop, going into an economy which is weakening gradually, and so we'll have to see if the stock markets do end up rolling over. But in the near term, yes, it was a down week for the S&P and mostly for stocks, with a slight uptick at the end. So we'll have to see how that pans out. In the very short term, there's still, despite yesterday's bounce, there is a short-term, shall we say, a short-term downside bias. Lastly, because I've realised I'm running out of time here, the clock's ticking away, and I've realised how long this video is getting. Gold was fascinating yesterday. Lovely to see this trend line get broken for the second attempt now that happened yesterday. But again a huge update there for gold. But for me, the a market which was more interesting was actually silver, up nearly 8% on the day, and in a far stronger position than gold at the moment. It looks far stronger. So I think this is a fascinating market here. And gold, I think both of them are fascinating on the back of these sort of candles. You've got to be looking at the long side. They've come down materially on the monthly time frames. They've congested for some time, and that is really quite a strong. One would hope or think that that is a strong indication that there should at least be some more follow through. However, as you can see, we had quite a nice candle just back in early October, and it didn't in the end amount to anything. But maybe this is the second attempt. So that's where we're at the moment. So gold and silver do look very interesting on the potentially on the long side. The dollar could be interesting on the downside, but we probably need to see those that inflation report next week, next Thursday, to really get any a bit more of a confirmation on that price action that we've seen thus far. Anyway, 16 minutes in. I better say goodbye. Have a lovely weekend. I'll see you next week.